Hey everyone, welcome back to the Your Money Your Life podcast, episode 197 of the podcast. Before we get into the episode, make sure wherever you're listening, you like, subscribe, 5-star rate, and review the podcast. Recording a little bit earlier because of a busy weekend, but it was an interesting week. There was some news that came out that was actually interesting stories that we're going to get into, and there was also our weekly market talk as well, and some other things that we have discussed. We're going to switch up the question of the week this week and talk a little bit more about concepts with personal finance. But yeah, let's get into it right away. I'm going to dive right in first and foremost to the market update, and we'll share screen so that those that watch on YouTube as well can keep up with us. First, I'm looking at and checking out CNBC.com just to see what's going on. Right now, the market's trading about flat. Today, it's midday when I'm recording. But the big theme for the market this past week has been actually a pretty decent jump in the past 5 days of roughly 2.3% of the market of the general market, and a little bit of an upswing, a little bit of a comeback of the market over the last month or so, just from the fact that we got some new data that we talked about last week. So that's the big theme right now. Again, trading flat. There isn't much crazy news out there. That's probably why the market's not moving that much. There are some earnings for some companies that have came out. Robinhood had tough earnings that sank 14%. Rivian slipped 2%. So some of these companies that are having earnings and are reporting their third quarter earnings, some doing well, some not doing so great. But we're waiting for the Fed. We're waiting for the Fed and what's going to happen next. Again, we saw the Fed paused again on the rate hike. We saw the unemployment rate moved up a tick, moved up a slight bit from, what was it, 3.8 to 3.9% or something of that nature. So we're seeing signs of the slowdown that we've talked about that we would get into in quarter four and Q1 of 2024, which we're seeing those signs, the slowdown start to pick up. So that's the major thing in the market. Again, nothing crazy. We already knew that we've seen a little bit of resurgence in the last month or so, or last few weeks. So that's the big thing in the market. If you look into current events and news and updates, Bumble CEO. So Bumble CEO is stepping down. This new incoming CEO, Lydiana Jones. Hope I pronounced that right. That's an interesting name. I haven't heard that name before. But they're saying that she's going to have a tough time because she has to contend with a slowing company, meaning they're slowing their growth. They have fierce competition with Match, Tinder, Hinge, which is all under the same umbrella, of course, under Match. But Bumble is a company that I've been bearish on for a while, just because of the fact that they don't. There's some key things for the company that I think was just key performance metrics that I knew weren't great. And so they're saying the new CEO is going to have a tough go around to try to make the stock. Again, this is a public company. Let's remember that, folks. Bumble's a public company. The stock has not done well at all. I don't even know what their ticker symbol is. BMBL. And I'm curious what they've done since, year to date, I'm sure is bad. Down 30%, over 36% year to date, while the market conversely has done roughly like 13% gain. All time since its IPO, down 81%. So this is a company that IPO'd. It still has a $2.5 billion valuation, which is shocking to me. I think that goes considerably down when you continue to watch the metrics. Unless this new CEO can change strategies, can do stuff to really bolster the company. And we'll see. It's going to be a tough go after Whitney Wolf, has the founder of Bumble, led the company for many years, is stepping down and probably just stepping into the chairman role and stepping out of the day-to-day operational CEO role. So interesting to watch if the new CEO can make a change. We'll be keeping an eye on that. Too many retirees. Have you ever heard of this, folks? The Great Resignation. Do you remember that time when the Great Resignation, everybody was switching jobs? But now they're saying this is a great retirement, that there's too many retirees out there. So there's about 2 million more retirees in the US today than predicted by the Federal Reserve. And this could be largely attributed to COVID-19 pre-pandemic. So the participation rate for workers 65 and older hovered around 21%. Now it's down to 19.3%. Even if retirement age Americans want to return to work, it can be a challenge. And that, of course, is thanks to ageism and other factors. So last year, older Americans took nearly 8 months to find a job, or 9 weeks longer than the overall average. So they're pretty much saying that there's too many retirees, and some of these people want to come back into the workforce, but they just can't. The labor market's getting tighter. They're trying to find a job, and they're older, so they may not be as hip to technology. Ways to find a job using LinkedIn or different areas or networking, and it's difficult for them. So it's a demographic issue, and again, a lot more people retired than would have during the pandemic. And so it has created some issues, and that's that. So I think that's interesting to watch, and how that plays into the labor market, how that plays into just the overall economy going forward. So that's something we'll keep our eye on. Another thing that we've been keeping our eye on is the housing market. They're trying to say because the mortgage rate, the 30-year fixed mortgage rate fell a little bit last week, that the housing market's showing signs of life. I don't completely agree. There was a little uptick in applications to refinance a home, and mortgage applications climbed up a bit. But again, it might be, the last bit of seasonality before we get into winter, which is typically a slower month for the housing market. So that's going to be seen. I don't see some sort of resurgence so far right now in the housing market. But again, we're watching these metrics week after week, month after month, just to get a pulse on what's going on. Another thing that we've been watching throughout the summer, throughout the fall, is consumer credit card debt. Consumer spending has fueled economic growth, but now Americans' credit cards has hit another record. It surged to 1.08 trillion in the third quarter. This is the latest report from the Federal Reserve Bank of New York. The 154 billion spike in balances is the largest annual increase since 1999. Delinquencies also rose to the highest level since 2011, particularly among millennials and consumers with student or auto loan debt. So again, this is showing that budgets are tighter. Of course, it's inflation. Of course, that's overspending from a consumerism culture in some cases, and then people, maybe it's slowdown in jobs and the ability to just job hop and get a higher paycheck or get a greater paycheck. Now things are slowing down in the labor market. Inflation's still high. The overspending was still rampant. So you're seeing everywhere across the board credit card debt surging to its highest levels. And I think that continues to hurt economic growth going forward as people have to shift from consumerism and buying to saving and paying down debt, and really getting a tightened hold on the budget, which we'll talk budget in our roundtable here coming up in a little bit. The Consumer Financial Protection Bureau wants to treat apps like banks. So they want to be able to regulate digital wallets and payment apps, from the likes of Google and Apple, in the same way they oversee traditional banks. So that traditional banks, because of the Dodd-Frank ruling, I think that was in 2008, during the Obama administration, they came out with a new regulation to really tighten constraints and tighten the regulations around banks and how banks operate because of the housing crash and the credit crunch bubble we saw in 2006, 2007, 2008. So with that said, now a lot of these fintech companies, these big tech companies are acting similar, doing some similar functions as banks, but they don't have the same oversight and they don't have the same restrictions. So they're trying to propose a rule that will be subject to public commentary through January that targets 17 companies handling over 5 million transactions annually, or 88% of the market. So the banking industry has long pushed for greater government scrutiny over non-banks. So if the CFPB wins its approval, the super oversight would significantly expand its visibility into the operations of the market's largest operators. So the bank's pretty much like lobbying for them to be able to have the same oversight that they have, because it cuts into their mortgage. You have to hire these risk and audit and all these different people, regulation people. And you have to do things differently with your cash. It's a little bit different with the larger folks like Google and Apple because they have so much cash. They're not at risk for any, inherent issue with liquidity or issue with credit or any of those things. But some of these smaller fintech companies, they're just growth companies, could need some oversight. And that's going to be something this Consumer Financial Protection Bureau is going to try to enact. So we'll watch that closely. And if you want to have public commentary on it through January, you certainly can go to the website and create your public comment. So something to watch out for on that side. More on credit. We're like talking credit crunch right now. Buy now, pay later companies are actually getting profitable. And they're getting profitable for the reason you probably wouldn't think. It's not because, so if you remember, for those that don't know, buy now, pay later companies are the companies that say, hey, you want this pair of jeans, you don't have $200 right now, buy it in 4 easy installments of $50 each, spread out over, a month payment every month, and then you can have it. It's kind of like layaway, I guess, if that's what layaway was. They're doing it digitally. So they got really popular during the over exuberance of 2021, 2020. And now they weren't profitable, but now they're one of them. Klarna is showing profitability over the last 4 quarters through being stringent and more, much more stringent on who they extend credit to. So of course, these firms will, if they don't get the payment from someone that says they're going to pay in four installments for the $200 of jeans, then they have to write off that loss, that credit loss. But now they're being much more stringent, and you're seeing credit is harder to get now. Credit card companies, all these different things, it's harder to get now because people are being stringent as rates are higher, and they know that people won't be able to make these payments in a lot of cases. So they got more stringent on their credit lending, and they cut the losses on the credit side by 56% because they're being pickier who they lend to, and who they dole out these risky loans to. So Affirm is also going to report as well. So they're doing this to, again, we're talking about this credit crunch. Things are changing. Credit and liquidity is much harder to get a hold of, and that's such a common theme you're seeing in the economy so far. Is that credit. Speaking of people buying things on credit, the tour gamut with Beyonce and Taylor Swift, the live music tour was such a thing over this past summer, and two of the biggest artists in the world. I think Drake was also on tour as well. Three of the biggest artists in the world went on tour, and Live Nation, which is of course a touring company that puts on these tours and owns a lot of real estate and has all the connections. They had an incredible quarter because of these, on the backs of Beyonce, Taylor Swift. They had the strongest quarterly performance ever, and they're on pace for a record year. Ticketmaster, they own Ticketmaster. They crushed expectations with 32% sales growth. Live Nation did. The bulk of Live Nation's money comes from producing concerts. That's promoting the operations and selling the merch. It raked in $7 billion from the concerts. Live Nation also made $833 million from its ticketing. It's come a long way from a growth company, and it was plunged. Remember, during the pandemic, there was no tours, nothing going on. The company was in the depths during that time, but it's quickly recovered since then. So they had an incredible quarter. And again, if you think about the landscape of tours, live shows, these are becoming premium products, right? Like, you can't go to a Taylor Swift show for a small amount of money. You're paying thousands of dollars to sing the Taylor Swift songs, whatever they are, to see Travis Kelce beside her. You're paying thousands of dollars. You're not paying small bucks. And it's going to become more and more expensive as they really build out this premium live product model it's a blessing to see these people in person. I would go to Beyonce concert. I've gone to one concert in my life. It was Drake. I'm not a big concert person. I would go see Usher. That would be one person in concert I'd love to see as well. So it's going to become even more and more of a bigger thing in the future. Something that happened recently is the ability for athletes, college athletes, to make money off their name, image, and likeness. Now it's called NIL. Before they couldn't do that, but there was a Supreme Court ruling that allowed for these players to do that as of recently. And so college football conferences, the athletic conferences, are going to they're now lobbying to create a coalition that they want to get federal oversight on how these student athletes get their NIL money, because they're saying it's getting messy. Players getting paid for different things. It's becoming professional. They didn't want that. And so after the Supreme Court ruling in 2021, where students could get cash from their name, image, and likeness, the college conferences are getting upset, and they want to change that because they're saying it's getting too messy in the way it's being done. They pretty much just want to take them back to amateur, but it's not going to happen. They're not going back. A lot of these kids have potential valuations. If you think of Bronny James NIL valuation, it's roughly around $6 million per year. Again, that's in marketing dollars that he could potentially make based on his social media following, his name, his brand, of course, being the son of LeBron James, all those different things, right? He has the highest NIL valuation of any college athlete, right? So they want to stop how it's pay for play. They want to stop that. I don't think that will be stopped. I don't think it should be stopped. I think these kids are just having a good time and making money off their hard work and sweat. Speaking of which, if we look here now, I want to talk a little more about budgeting, because we've talked about credit in our roundtable this week. We've talked about credit so much this week, and really what's going on, and it goes back to the budgeting, right? So the reasons why, if you're on YouTube, you're seeing what we're doing here. We're maintaining a budget because of, a few reasons, right? You can see where your money is really going every month. You can see how much you saved at the end of the month. You can fund an emergency account. So the budget really sets the foundation for you to do all these things, right? Fund an emergency account, see where your money is going. Should you increase your savings? Can you cut expenses? You're really tracking your spending with your budget. And sometimes it's harder to do. Sometimes we need a reminder, and that's all okay. So if you use a spreadsheet budget, you'll see your financial inputs and outputs. You'll understand your net cash. And if we break it down into little simplified budgets on where money should be going, of course, you have your essentials, right? You think about that piggy bank as your essentials. You have your mortgage, car loan, student loan, utilities, debt, all those different things. Of course, you either have built or you are building your emergency fund. And then you have what's called your investables. That's our IRA, traditional IRA, high yield savings account, health savings account, brokerage, crypto. Those are your investables. Could be 401k as well. And then, of course, you have your leisure and your spending, food, entertainment, different things, clothes, all that stuff. So you want to break it down into 50, 30, 20. We've talked about this before. 50% in needs, 20% in savings and debt retirement. I tell people you could flip that around when you're starting. It should be even 30% in savings and debt retirement, debt repayment, and then 30 or 20% into wants or leisure. Again, that's the spending. So you want to make sure you stick to roughly a decent rule around that. That might be a good rule for people to stick to. And if you look at it in a numerical way, and someone with 10K after tax income, 5,000 goes to necessities, 3,000 would go to savings and debt retirement or wants, and then the other way around, 2,000 go to the savings and debt repayment or wants. So you really want to get a good basis on that and think about the budget more as we get to different times. I had a client send me their budget. We went over it, discussed how to improve it, ways to increase income, ways to cut. But increase the income is one of the other ways, because if you think about it, you can only cut so much. You can't cut 20% of nothing if you're already living in just a normal, stable lifestyle, right? So increased income is always another way to think about that, because it gets super, super hard to continue to cut when you can't anymore. Folks, we have a lot more things that are being fun coming in the future. So make sure you stay tuned. Share this with your family and friends. We're doing a women's personal finance personal finance workshop. It's going to probably be the 17th. In the flyer, I had the 24th, but I realized that it's Thanksgiving. So we're probably going to do it the 17th. So again, for women that are non-clients of New Street, we're through the interest of demand, we're adding this, class for people to get, registered. If you need someone who wants to get registered, send them my way. We'll get them the registration form so they can get signed up. But of course, folks, thank you for listening, and we will see you next week.